Hi, so this is a video on the 2013 incomplete records question and question 7 on the 2013 exam. This is um, a forward traveling question, or a cash book method incomplete record as we call it, where you have to do the trading profit and loss account first and the balance sheet afterwards. Now, I'm meaning this video to be used as an extension video to the 2015 question, where I explained all the workings in detail. Here, any workings which are the same, I'm just going to skim over them, and I think you should go back and revisit the 2015 question for help in that. I'm really just going to spend time highlighting the new or different information in the 2013 question. So let's have a quick look at the question. It talks about E. Kelly and how he purchased a business on the first day of January 2012 for 205,000, which of course is the initial capital. Well, just like the previous question, the 2015 question, the previous video, what you do here with that opening capital figure is you put in the opening capital here at the bottom, and then you record all of the assets and all of the liabilities, and you're going to find that because it does not balance, he overpaid for the tangible assets in the company. He must have considered that there was an intangible asset called goodwill here. So when you work out all of that, you'll get your goodwill at 20,670. You will notice that cash, I still put cash in even though there was a zero balance. It's important that we remember that if there is a cash balance, it must go in there because it must also go in as the opening balance in working 2. So working 1 is the same procedure, except you have a different goodwill figure coming from it. Working 2, also pretty much the same procedure here. You put in all of the money out, cash payments, you take out your drawings of cash, you put in your closing balance. Take away the opening balance, but of course in this situation it is 0. So therefore that 171,170 is really an addition of these 5 numbers. Taking away 0 on this side leaves you with 171,170 as the cash sale. The bank account, you were given transactions on the debit and credit side here. All of the items here in black print are given in the question. Debtors, cash, dividends on the money inside, equipment, creditors, light and heat, interest, insurance, charity, delivery vans, and rent on the money outside. Now the loan is 72,000, and that is referenced in the second paragraph underneath the bank information, where it says Kelly borrowed 72,000 on the first day of July, part of which was used to purchase an adjoining warehouse costing 60,000. So you put the 72 on the money inside, and you put the 60,000 as premises on the money outside. That differential of 12,000 is just money that he has left in the bank account, and therefore that the fact that we're putting in more than we're taking out will reflect that. And at the end, you have a bank balance of 10,100. Now, unlike the previous question, there is no investment fund here. The loan is different here, and the question does not tell you that he is taking money out on an ongoing basis from his bank account to put it into an investment fund. Instead, he is making no repayment on this loan until next year. And we will talk about that when we get to the loan working later on. But you'll notice the lack of an investment fund at this point. Slight difference. However, working 4 is exactly the same, where we work out our total sales, and working 5 is exactly the same when we work out our total purchases. The drawings is a slightly different number, but the procedure is the same. So on we go to some of these other workings. And again, the process here is you see what is due or prepaid in the top sentence, then the bottom sentence, and then you tidy up the remaining issues. So in the top sentence, we have 3 months insurance prepaid. Therefore, that convinces us that we need to do an insurance working. You put down your original number from the bank account, you add on what's prepaid at the start of the year, and you take away the amount which is prepaid at the end of the year. Not given in the question, but if there is 3 months prepaid at the start, there must be 3 months prepaid at the end. You work that out, dividing the original by 12, multiplied by 3. The profit and loss figure for insurance is 2,680. Working 6, exactly the same as the 2015 question. You take away wages due at the start to get your actual and general expenses. Working 7, almost the same as the 2015 question. There is a closing stock, and in the question, it's interestingly put in along with the closing stock of trading stock. It says stock of 15,500, including stock of heating oil of 500. We need to take that heating oil and separate it out, and we do so here. And we take that heating oil away, you reduce or you minus the closing stock, because obviously if you have €500 of oil in your tank at the end of the year, you have not used it. So you subtract that, you add on the electricity due, and that will give you the amount of light and heat that's actually used. And you take 25% drawings off that to get your expense. And then that's everything in the bottom sentence dealt with, the light and heat. So now we go to the penultimate paragraph, and it talks about 2 more drawings. It talks about rent. Well, actually, one of the drawings is already done, light and heat. But it talks about rent. It says the rent, 22,800, is payable in advance, and it is in respect of an adjoining building rented by Kelly on the first day of August, which is 7 months into this year. There are only 5 months remaining in this year. So it was estimated that half of the building was to be used as a private residence. So straight away, you'd take out half of that as drawings, because it's the other half, it's the remaining 11,400, which is the business expense. And it is that on which we can say that there are 7 months prepaid, divide 11,400 by 12, multiplied by 7, and therefore the expense, and the profit and loss expense, is actually 4,750. That's the amount that will go into the profit and loss expense. The loan interest, working 9, very similar to the question we've done before. It is 72,000 by 10% by 6 over 12, because we borrowed this on the first day of July, and that gives you 3,600. You take away what is paid to find out how much is due, and that, of course, is the current liability, the loan interest due. Now, in the previous question, we had to take 25% drawings off this number. Here, there's no mention of that, so therefore the legitimate business expense is the full 3,600. Now, that is coming from the middle paragraph about the loan, where you're told about 10%. And in there, you're also given the information about the loan repayment. Let me talk to you a little bit about that. It says, Kelly borrowed 72,000 on the first day of July 2012, part of which was purchased in an adjoining premises of 60,000. We've recorded that. The second sentence, it was agreed that the sum borrowed will be repaid in 12 equal installments over a 6-year period, commencing on the 1st of January 2013. Now, if you have 12 equal installments over a 6-month period, well, if you divide your loan by 12, that is 6,000 are the amounts of the equal installments, and we're paying off €6,000 every 6 months. If it's 12 payments over a 6-year, sorry, that should say over a 6-year period. I'm just going to change that. If it is 6,000 every 6 months, if it is 12 payments over a 6-year period. So therefore, 6,000 is going to be paid twice a year, starting on the first day of January 2013. In other words, there will be 2 payments next year. Therefore, how do we do that? We're going to move 6,000 by 2, which is 12,000, from being a long-term liability in the finance by section to being a more immediate current liability. a creditor which is falling due within 1 year. So we move 12,000 up from the finance by section to the current liabilities section. I'm going to show you that in a moment when we look at the answer anyway. Here's our drawings, and there's one less drawing than the previous question. The drawings total up to 19,865 stock and cash, and then from the second last paragraph, rent and electricity. The drawings is always the last working, so therefore we can go and do the actual accounts. Now in here, this is all exactly the same as we've looked at before. So your gross profit is 1,283.30. Everything straightforward. One thing to note here: the closing stock is just the 15,000. We do not include the stock of heating oil. We separate that out because, of course, we've done the heating oil stock in here in the light and heat working. This is just the 15,000 trading stock. Insurance, general expenses, rent, light and heat, charity, which was just straight from the bank account, and interest, all of these are our expenses. And there is no income in this question because there is no interest received on an investment fund, for example. So then we go to the balance sheet, and in the balance sheet you have 3 fixed assets which are tangible. The premises, now that is 174 plus the new premises of 60,000 to bring you to 234. The delivery van and the furniture both purchased in the bank account. You add on your goodwill, and this zero here would have been the investment fund if we had one, but we don't have an investment fund in this situation, in this question. Now, our current assets. So we're going to have a quick look at our current assets here. And we have our closing stock, which is from the bottom sentence, and the closing stock of heating oil. Both of those, you can put them in together, but we've treated them separately throughout the question, so you can put them in there separately. The debtors, your bank account from working number 3, and your cash account from working number 2. And in there you also have rent prepaid, which is from the rent working, and you have the insurance prepaid, which was the very first working that we did, working 6, the very first one after the initial 5. Now then, in current liabilities, we have our creditors of 14,300. We have our loan interest of 1,200. We have our loan repayment due of 12,000. Now I'm just going to move this down a little bit so we can see what's happening there. Get to the end here. Okay, but it's quite important what we are seeing here. Here is our loan of 60,000. Now, of course, we know that we borrowed 72,000 and we still have 72,000 owing. But because 2 of the payments, totaling to 12,000 to 6,000, are due immediately next year, we transfer them from being a long-term liability up to being a current liability. That's where that 12,000, and I've put them both in green there so you can know that they're related. That's still 72,000 euro we owe. It's just that 12 of it we owe quite soon, i.e. in the next 12 months. You also have your electricity due. You work all that out to get the total fixed assets, and then we are free to look at our finance by section. We have our loan, we have our capital, which is 205,000. The capital introduced is the dividends again from the question. I should have flagged that earlier on, but it's the same as the 2015 question. You add on your net profit and you take away your drawings, and you'll end up with the same capital employed number as your total net assets. Finally, there's a little bit of theory. It says what additional information will be available to Kelly if he used the double entry system. So the whole premise of an incomplete records question is that the person is not doing proper double entry accounting, and therefore we have to come along and help him to resurrect a set of accounts out of the incomplete records that he has provided us. But if he were to use a proper double entry bookkeeping system, then the following would be available to him. And it's basically all the things which we have adjusted above. He would have full general ledger accounts, like an insurance account, a light and heat account. He'd have a trial balance. He'd have a proper figure for sales and for purchases. He'd have a bank account. He'd have a capital account, a drawings account, and any other expenses, and the amounts due and prepaid. Basically, all the adjustments we had to do earlier would be readily available without resorting to estimates or guesswork.